Oh boy, this is it. This is the entire semester in one presentation. Risk versus return, risk versus reward. Do you want to eat well or do you want to sleep well? So, dear students, please go over this presentation maybe 2 or 3 times because this is the this is boils down our relationship with our potential investments. So let's get started on slide 35. Now, one little note: I've been having troubles with the closed captioning. So if they disappear and I stop, my apologies. Hopefully, I figured it. I don't know what happened. It started happening and now it seems to not be happening, but we'll see what happens again. Slide 35. Over the long term, equities, stocks, businesses have produced the best return. And if you remember from the previous presentation, we tell people 8, 9, 10%, although they've actually done better. Some have done a whole lot better, some have done a whole lot worse. Bonds, fixed income securities, loans, mortgages, if you will. 3 to 6% depending. Treasuries and governments and municipal bonds, state and local governments, less than corporate bonds. And there are some corporate bonds that pay a high rate of interest, but we call those junk bonds. Distressed, speculative, non-investment grade. Short-term cash investments, savings accounts, CDs, money markets, anywhere from 1 to 3%, sometimes more. For an awful lot of years, a lot less than 1%. And mutual funds were more or less, often less, reflect the underlying investments that they invest in, the underlying assets. If it's a mutual fund that invests in stocks, it should hopefully do as well as stocks, likewise bonds, and then money markets will follow the cash instruments. So here is a graph that shows from 1928 to December 2022. I have to put a little disclaimer here. The official inflation rate won't come out for a few more days, and so I'm choosing the one that is people are expecting it to be, the estimated. But it might be a little higher, might be a little lower. It should be around 7%. Maybe it's not going to be 8%. Maybe I don't think it will be. But if it's way off the beam, then I'll go in and change it, but it shouldn't be. And we notice that a dollar back in 1928 has done pretty darn well for us. If we invested in stocks, it's gone up exponentially. Whereas, bonds have done okay, but nowhere near as well as stocks, and treasury bills, short-term investments, have barely kept up with inflation. Now, there's a warning. See, if I were king or emperor of the world, especially the math world, I would require all logarithmic graphs to have a warning label, because people don't really understand logarithms. Why do we use logarithms? I'll tell you why. Because they allow us to see a exponential graph in linear form. Now, what does that mean? I will stop and show you the graph as if it were arithmetic. But think about it, folks. Look at this graph. It starts off at 0 and then goes to 1. Whoops, sorry, my mouse is so sensitive. And then it goes to 10, and then 100, and 1,000, and 10,000. So every increment is not 1 unit, it's 10 times more than the previous unit. And this is why people don't really understand logarithms. We use logarithms for numbers that get big very quickly or very large. For example, earthquakes. You hear about the Richter scale, and you live through a 4.0 or a 4.2, and you go, well, that wasn't so bad. An 8 can't be that much worse. Wrong. It's 10 to the 4th time, 10 times 10 times 10 times 10 times more powerful, 10,000 times more powerful, and a 9 would be 100,000 times more powerful. And so that's why we really shouldn't use logarithms with most individuals who really don't understand them. But just understand that this is trying to show you a huge difference between what stocks, bonds, treasury bills, and inflation have done. In fact, let me pause for a moment and get you the graph if it were arithmetic. Oh, here it is. It's showing you that stocks have done very, very well, and you can't even see bonds or treasury bills, short-term investments, or the inflation. That is why we use a logarithmic scale so that we can compare them. It turns this exponential curve into a straight line. So let's go back to the logarithmic scale and understand that the difference is enormous. And that just makes sense, right? The standard of living has increased many-fold since 1928. In fact, let's take a look at an even longer time frame and go out to 1800, at the dawn of the industrial age, and where we've seen a dollar invested in stocks, businesses, turn into $44.5 million. Bonds have done pretty well, 46,000. Savings accounts, short-term investments, treasury bills, and the like have done actually pretty darn good compared to inflation, 5,900. But look at measly gold. When you started taking this class, did you think, when are we going to talk about gold? Later. But I'm going to show you this graph right now, and you'll see that as an investment, gold really hasn't done that well. And so when people say, I want to invest in gold, I say, okay, well, let's take a look at how well gold has done. Teach me more about stocks and bonds, okay? All right. But again, here's that warning. Where's the warning label? It's another logarithmic scale. And so these little dips and jumps in the world of stocks don't look that big, do they? They're huge. They're enormous. Notice how small the dip in 2022 looks, even though the stock market went down, depending on what part of the stock market, but overall, the Standard & Poor's 500, what's that? We'll discuss it later, but it's a list of 500 companies. It went down 18%. That doesn't look like an 18% drop, does it? Right, that's because the numbers are so huge that a little bitty drop is a big drop, because it was like 57 million last year, right? But still, nobody has a 200-year time frame. But still, this is the idea, folks. This is the idea. Stocks have done well. Businesses have done well. Our standard of living has done well. And those who've invested have been well rewarded. Notice when gold does well, when people believe the world is going to end, like the Civil War and the Depression, World War II. And then we saw gold start to levitate after the 1970s for various reasons. But in 1981, it hit $800 an ounce. In 1999, it was $250 an ounce. So you had 20 years almost where it just kept going down and down and down. And then it skyrocketed in the 2000s because people thought the world was going to end with 9/11. And it sort of dipped around. And actually last year, you would have thought, with inflation rearing its ugly head, that gold would have done well. Actually did 0.5%. People keep saying, oh no, gold is going to go to $10,000 an ounce. They say the same thing about Bitcoin too. So what do you think? Yeah. Now don't get too excited, right? We're going to temper your enthusiasm, because all is not peaches and cream. We have to deal with ooh, is it too late to get out, right? We have to deal with those downturns. And we're going to give you some tools and some strategies to do that. And in turn, we're going to learn how to turn those downturns into advantages, especially if we're young and have a long-term time frame. And don't panic. Slide number 38, investment risk. Look, folks, it is no accident that stocks and bonds have produced better returns than short-term investments. It's no accident that they've done better than cash, than savings accounts in banks or treasury bills. Otherwise, why bother, right? If you could get the same return from a savings account that you get from stocks and bonds, you would take it. Why would investors assume the additional risk of stocks and bonds? They wouldn't, right? They would just assume what is called the risk-free rate of return. Now, notice it's italic, so that means they want you to study it and understand what it means. And when people ask about what's the risk-free rate of return currently, they typically will quote you the 3-month treasury bill, which is one of the things you're going to look up in your assignment for chapter 1. The risk premium is that reward for bearing risk, the extra return on a risky asset over the risk-free rate of return. In other words, okay, we've seen that stocks have done well. How well have they done over time than treasury bills? We've seen that bonds have done okay. How well have they done over the risk-free rate of return, over treasury bills, or money markets or CDs and the like? And here's a little table that shows you how well they've done from 1928 to 2022. During this period, inflation was about 3%. I know it's all in the news now, but over the long term, about 3%. The Federal Reserve Bank is trying to get it back down to 2 or 3%, and we'll see if they're successful by 2024. But the average return on stocks, remember we said 8, 9, 10%? Actually, they've done better, 11.5%. A year ago, it was almost 12%, 11.9. Notice the risk premium. By taking on the additional risk of stocks, we've beaten the risk-free rate of return by 8 percentage points, which is pretty darn good. Bonds have done, not so bad, almost 7% large company corporate bonds. Treasury bond, and that's a 3.5%, 3.6% risk premium. Treasury bonds, almost 5%. Hey, it's the United States government, 1.5%. And of course, treasury bills have not beaten themselves. The risk premium is 0. So you see, we're taking on more risk. We want to get more reward, right? Why bother? If you could just get the same reward from a treasury bill, you'd take it, but it doesn't work that way. Slide number 40, risk versus reward, risk versus return. Investment return is very straightforward, right? How much did you start with? How much did you end with? How long did it take you? That's your return. But measuring how much risk you took to receive that return is much more difficult. In fact, it's impossible. How do you measure risk? How do you do it? I mean, there are ways to quantify risk, but none of them are perfect because you can't anticipate what's going to happen. You don't know what's going to happen in the future. Return is looking in the past. Risk is looking into the future. Each year, the investment community measures the average annual return and the amount of variance, the amount of how far away the return is from the average return. And using statistics, don't drop the class. We don't have any statistical calculations to do. I know you hated statistics and permutations and combinations and all that stuff. We just look them up. But we're going to need to understand the measurement, even though we're not going to do it. The resulting measures of risk are called variance and standard deviation. So, slide number 41. We will leave the calculations for your statistics class, okay? Okay, all right. Don't drop the class, folks. There's nothing to worry about. Look at all those scary looking symbols. Suffice to say that the higher the variance and standard deviation, the riskier the investment. That should actually be in italics, right? The higher the variance and standard deviation, the more the investment return will vary, will deviate from the average annual return. These are just fancy schmancy terms for you can lose a lot of money. And what is this calculation? All these sigma and all these strange calculations. Well, really, what you're doing, folks, is you're saying, okay, I got a data. I got some data. I got a data set over the last 80 years, 20 years, whatever. I've returned a certain number, say 11%. But every year it's not 11%. It's 22 minus 3, 17, 4 minus 10. It's all over the map, especially with stocks. So we take that return every year, sub I, the ith year, the current year, and we subtract it from the average. That's what the little bar means. Means the mean, the average. And then we square it. Now, why do you square it? Well, you square it so you get rid of all the negative numbers. Again, you're not going to do this. Don't worry. You just look it up. It's all done for us. And then we sum it up. That's what that big E stands for, sigma. And then we divide it by the number of years minus 1. Why do you use the number of years minus 1? Take a statistics class. You'll learn about why we use n minus 1. And that's the variance. Now we take the square root, squirt, of the variance, and that gives us the standard deviation. So again, please don't drop the class. You don't have to do these calculations. They're done for us, but we need to understand them. We need to understand that the higher the standard deviation, the more likely we are to not get the average return in any one year. And so we have to be ready for that. We just have to know it in advance. This is called a distribution. Here are the returns for the years from 1926 to 2022. And so what does this mean? If the return was between 0 and 10%, then the year went in here. If the return was between 10 and 20%, the year went in this column. And then, of course, if it's negative, between 10 and 20%, minus 20% to minus 30%. And so notice that 2022 was actually not the best year. In fact, it was not a very good year at all. But there have been so many great years, 2021, 2020, 2019, 2017. These were all very good. Notice 2018 was just a little bit negative. It really, like only, I think it's like a 3% or something like that. But notice 2008, 2002, 1931, 1937. There's gonna be years like these, folks. You just have to prepare for them intellectually, but more importantly, emotionally, because they're gonna happen. History tells us, look at this. But then there are gonna be years like 1958, 1935, 1928. Wait a minute. Wasn't that 1935, 1933 during the Great Recession? Yeah. The 1928 was right before the Great Crash in 1929, and then 1930 and 1931, and stocks lost over 80%, almost 89 or something, 88.6% or something like that. But then, of course, the backlash, 1933, 1935, they came roaring back. Yeah, that's how it works, folks. It's a pendulum that swings back and forth and back and forth. And so we have to be ready to just let it swing and don't jump in front of it and try to anticipate it. Oh my goodness, that's called market timing. And we'll see that people can't time the market except those of us who lie to ourselves and lie to others. But does this graph, this distribution resemble anything that you're familiar with? Does it look somewhat familiar? I hope so. It's the normal distribution, the bell curve, the normal curve. You know, nature's been very kind to statisticians because it turns out that so many things in the natural world follow a normal distribution. The height of humans, right? Most people are a certain height, give or take a certain amount. And some people are very short, and some people are very tall. The length that your car battery lasts, right? It follows a normal distribution. And so we find that the same thing happens in the world of returns. In the world of returns, the stock market has returned 11.5% from 1928 to 2022. But it has had a standard deviation of almost 20%. Right. And so what this is telling us is there's about a 2/3 chance, plus or minus one standard deviation. Again, don't worry about that. You learned that in the statistics class. There's about a 2/3 chance that you're going to get somewhere in between 31% and minus 8%. It's very rare that you're going to get 11.5% in any one year. And then there's about a 95% chance that it will be 2 standard deviations. Now, you don't know up or down. You don't either plus 2 standard deviations or minus 2 standard deviations. Minus 2 standard deviations, excuse me. So there's a 95% chance that the return will be somewhere between 50.5% and minus 27.5%. And then come along every 100 years or so, a 1% chance that it'll be 3 standard deviations away from the average annual return. So we're looking at plus 70 to minus 47. Now, does this graph tell us what it's going to be next year? No, nobody knows what it's going to be next year. I mean, we have very smart people who are paid a lot of money to incorrectly guess what it's going to happen next year. And we not so very smart people usually do about as good a job as those very smart people when it comes to predicting the future. But we do know that it's going to vary. And that's the takeaway. We don't panic when we see the market go down because we know it is a perfectly natural event. And unless the world ends, or tsunami, meteorite, World War III, Senor Putin, I think the next 20, 30 years are going to be very, very prosperous. Having said that, there are going to be years like 2022, 2008, 2001, 2002, 2000, when the market goes down, and oh well, we learn to live with those. In fact, we learn how to prosper, how to take advantage of those. Stick with us. Okay, so here's another view of risk versus return. Notice, stocks have done the best at 11.5%, and of course they have the highest standard deviation. Corporate bonds have done better than treasury bonds and actually have a little lower standard deviation, but very similar. I mean, they're almost exactly the same. But notice how much lower that standard deviation is from stocks. That's why we say bonds are far less risky than stocks. They still go up and down, and some years they go down, 2022. But they go down far less and far less often than stocks. Treasury bills, notice the very small standard deviation. In fact, Treasury bills have a smaller standard deviation than inflation. But remember, repeat after me. The greater the average annual return, the greater the average annual return, the greater the standard deviation, the greater the standard deviation, and the riskier the investment. So again, we talked about risk. Risk is something we normally think of as something bad, right? But in the case of investments, we just say risk is that probability that our investment return will not be what we expect it to be. If we're armed with that information, cool. We understand that there's going to be times when markets are going to fall. That's just something to be part of life. So now, we can complete the global picture regarding risk versus return. Who had the best risk-adjusted return? Sweden may have had the best average annual return, but you had to accept over 30% more risk to get that return. Are you with me? You see, sure, Sweden did 13.5%, and the United States did 10.7% over this 1970 to 2021. I think this is right. Um, but Sweden had 22% uh, standard deviation over that time. And notice that even though our standard deviation is almost 20% since 1928, it's gone down in that time. It's about 16.5% here. The real kicker is here. Italy and Austria and Spain, you're getting a lower rate of return and you're getting a hell of a lot more risk. Notice Australia is a much more stable economy. It's not as dynamic as the United States, and it hasn't done it as well in terms of return, but it has much less return. So does Canada. So this is what you expect from those very, very sedate countries. So you with me? You understand? There's a reason why the United States stock market and the United States itself is admired throughout the world, because investors know that, yes, you're going to get a very good return and you're going to get a very good risk-adjusted return. You might not get the best return, but it's not going to be as bumpy as if you had invested in, say, Sweden or, well, the Netherlands did about, Netherlands. And so we're awesome. We take ourselves for granted a lot of times because we're here. We live in this society, and it's all around us. But the rest of the world does take note that United States stock market is certainly one of the best if in terms of risk versus return, risk adjusted return. Okay, I'm not trying to denigrate everybody else, folks. There are great companies all around the world, and as we said in the first presentation, we want to think globally. But, we need to pat ourselves on the back every once in a while, I think. Anyway, slide number 46. Does yous got it yet? Yous want highs returns? Yous gonna get highs risk. Yous gonna lose some money, maybe all your money, depending on how you react. And if anybody tells yous differently, they're lying. Okay? Okay. I'm from Philadelphia. So when, not if, but when you see an advertisement for a 12% safe rate of return, yeah, you can't lose 12%. You will know that the chances of losing your money are pretty darn high. When you see claims such as 300% or even 3,000%, and you will, if you're involved in investing any length of time, you're going to see these outrageous claims of investments. In fact, there's one on the website and in Canvas, if you're following through Canvas. This guy says he turned 33,000 into 2 million over 7 million over 2 years. It's just ridiculous. It's total BS. But they get away with it. Sit on your hands, grab your wallet, stay away. And by the way, these people are breaking the law. Now you might say, well, wait a minute, we have the freedom of speech here. Well, they can say pretty much whatever they want. No. This is the industry, the financial industry, the investment industry is highly regulated. And before you make any claims, they have to be vetted by the Financial Industry Regulatory Authority. They're the group that oversees stockbrokers and the brokerage firms. And the Securities and Exchange Commission is the entity that watches out for people making these horrible claims, and they do it all the time. And why do they get away with it? Mostly because the SEC just can't. They don't have the resources to. It's like whack-a-mole. They go after the most egregious people. This one guy, Wade Cook, got away with it for decades until they finally put him out of business. And here, if you're interested, look these people up. They're going to tell you that they can teach you how to make $1 million overnight, and they're lying. By the way, the same thing happens in the health field, right? You can't just claim that this supplement is going to, grow hair or make you virile or whatever, but they do. And some of them put dangerous chemicals, and sometimes they put drugs that you have to get through a prescription, believe it or not. So there's a link on the website. Check it out, from Dr. Greger, an awesome gentleman who runs a website called nutritionfacts.org. Check it out. And be careful when you see, because I mean, these things can empty your wallet, right? But some of those things can dissolve your liver, dissolve your pancreas. So, whereas losing money is not fun, losing your life is not fun, is even worse. So be careful, folks. Be careful. If it sounds too good to be true, all right. Slide number 47. Okay, but isn't somebody doing it? Come on, Piano. Somebody's out there making a ton of money quickly. Yes, it is true. There are some people who make tremendous rates of return. But folks, they're not investors. They are traders, TRDERS, speculators, not traitors, but traders. And 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 we do our best in this class to make you understand that there is a difference between a trader and an investor, a difference between a speculator and an investor. And here is a wonderful quote from one of the first well-known and successful, ultimately unsuccessful, he actually committed suicide eventually, speculators, Jesse Livermore. The speculator is not an investor. His object is not to secure a steady return on his money at a good rate of interest, but to profit by either a rise or a fall in the price of whatever he may be speculating in. Being a trader can be very profitable, folks, but you're up against the best in the world. It's incredibly stressful, very perilous. What can I tell you? I wish I could help you with this. If you want to be an investor, we can help you. We can help you learn how to become a patient, prudent, successful, long-term oriented investor. We cannot help you learn how to become a successful short-term speculator. Sorry, I can't do it. I'm not going to even try it myself. I don't think I could help you do it. I can point you in directions and do my best to dissuade you from trying. And it turns out that most of these people don't last very long, maybe 3 weeks, maybe 3 months until the money's gone. And in the face-to-face class, we would now read a little story from about John Gutfreund and John Merriweather. It's from a book called Liar's Poker. It is a phenomenal book. And anything by this guy, Michael Lewis, you want to read because he's tremendous. And it really does show you, folks, these traders, you don't want to mess with them. And I don't know if it's a story called Liar's Poker. I don't know if sometimes sports analogies work, but have you ever gotten a battery box and had a fastball go by you at 60 or 70 miles an hour? It's a very humbling experience. That's how fast the machines go. But remember, in the major leagues, they're throwing that ball at almost 100 miles an hour. Can you hit a little white golf ball 300 yards or 400 yards down the fairway in 3 shots? Can you dunk a basketball? Can you sing a 4-hour opera? Can you write a best-selling novel? Can you direct or act in or write the music for a $200 million blockbuster movie? You and I can't do these things, but there are people who can. And there are traders and speculators who do very well. But it's not for the vast majority of us. Yes. In fact, in the face-to-face class, we used to, I can't find it anymore. Forbes took it down. But it was a wonderful video of an interview of a gentleman by the name of Jack Bogle. I'm not sure how to say his name. But he really says it right. He goes, why don't people teach this? And I said, we do, Mr. Bogle, we do. We teach it. The difference between a trader and an investor. So, what is a realistic rate of return for me? After you have taken this course, you will have a strong knowledge of the most popular types of investments: stocks, bonds, short-term investments, cash, mutual funds. You will also know what levels of return and what levels of risk you should reasonably expect to receive. And if you are a patient, long-term investor, I believe it is realistic to expect 8, 9, 10%. I'm certainly working on it myself, and it's been many years, and so far so good. Tomorrow the meteorite could come, or California could get earthquaked. Who knows? But so as we say, we're going to reiterate time and time again, there are no guarantees when you leave the world of short-term investments. Okay, Payano, is that good enough? Is 9 or 10% good enough? Well, it turns out that the answer to this question is yes, if. There's some ifs here. If you start early, if you are patient and consistently invest, if you don't get too cocky or greedy and chase after every next big thing that comes along, and most importantly, you don't panic when the market swoons. That's what kills people. You hear them say, "Ooh, is it too late to get in?" Yes, it's too late to get. When you hear people saying that, it's too late to get in. And then the market crashes. And then, oh, is it too late to get out? Yes, it's too late to get out. Don't sell now. Unless, of course, you bought Bitcoin or Beanie Babies or whatever. Because that's when you earn your money. I know it sounds bizarre, but don't panic when the market swoons, as it inevitably will do from time to time. We see that from history. We know it's going to happen. We just don't know when. The trick is to take advantage of the time value of money. You'll hear people say it's time in the market, not timing the market. This is called compound annual return. Time value of money, we're not going to spend a whole lot of time on this, haha, no pun intended, in chapter 1. You don't have to do any calculations. They are there for your perusal. At least look at the answer keys. We do these calculations in the Business 121 Principles of Money Management class. We'll come back to them later, but we'll look at them from the inverse. We'll look at present value. The time value of money is the amount to which a sum you invest now will increase based on a specified rate of return and a time period. It's called compounding. That's why you hear the term compound interest, compound rate of return. It can be computed for a single amount, a lump sum, a single payment, a lump sum principal, or it can be more useful for most of us, computed for a series of investments, a multiple payments, a stream. I like the term stream because it makes me think of a river. Stream of investments, or I put the quote and put the word annuity in quotes because you got to be careful. Annuity is also a product that insurance companies sell, but annuity just means a stream of money. That's all it means in its purest sense. We're going to learn to move from the future back to the present. That's called discounting. What an unfortunate term that is. When we learn how to assign valuations to stocks and bonds. So for this class, for this chapter, look, if you want to do the calculations, some of you have already done them in the Business 121 class, and you can do them. They're pretty straightforward. You need the table, and if you have one of these calculators that does it, or an application on your application on your cell phone, you can do it very easily. And it shows you that, yes, if you have the time, you can do very well, assuming the world doesn't end. So we're not going to do the future value exercises. And in fact, I haven't really done them in a long time in this class. I've basically just show people the answers. But if you want to do them, fine. We're not going to, again, they're not going to be on the exam. You don't have to learn how to do them. We're going to hammer the present value, the inverse operation, when we get to stocks. And that is so cool. Folks, I'm sorry, I'm getting excited. Okay. So one last comment on risk versus return. Psst. Here is one of Payano's secret tips. Avoid large losses. So here is a couple of investments. Here are a couple of investments. Investment A and investment B. And this is something that I learned a long time ago and you have been using for many years, because in I forget what year it was, 1999. Yeah, the Nasdaq, which is the tech-heavy index that companies that like Amazon and AOL online at the time, 1999, and Apple and Microsoft and Intel. They're in the Nasdaq, and it did 85% one year. And I just looked around. I said, no, it's not gonna. This is not gonna continue. And then investments that were boring, they were, some of you weren't even born yet, but they were called the old economy companies. Like railroads and food companies and yeah, very boring companies. And they did like 10%, right? So people were so excited. Ooh, is it too late to get in? So your $100 becomes $185, and then the 10%, $110. But the next year, the Nasdaq loses 50%, and some stocks lost 90%. And eventually, the Nasdaq lost 80% as a whole. But the other guys, chug along. It's a food company. What's going to happen? Well, you think, oh, okay, well, I'm still up 30%, right? 35%. No, it doesn't work that way. The numbers going down are a whole lot worse than the numbers going up. Yeah. So we are going to, and it's just a preview of what we'll do later on. We're going to emphasize companies that have their roots deep in the economy that are really boring. And don't worry, we'll see some exciting, sexy, whatever you want to call them, stocks too. But avoid large losses, in my humble opinion. And okay, now, before we embark on the process of identifying and familiarizing ourselves with the longer term, higher yielding investments, let us learn how and where to park our money using short term investments, right? But wait a minute, wait a second, one more time. The greater the variance and standard deviation of the average annual returns of an investment, the greater the risk, the more volatile, the more it will vary. The lesser the risk, the less volatile it will be. There is no correlation, no relationship, or standard what? I always hated statistics. Folks, don't get this wrong on the exam. All right, it's bad for my self-esteem. It really is. Don't get it wrong on the exam. The greater the standard deviation, the greater the variance, the greater the risk as measured by the imperfect measurement of variance and standard deviation. Okay, go back over this presentation, please. Make sure you understand that once you embark upon longer term, higher yielding investments, there's gonna be, I think I've said this, there's going to be times when you're not going to be loving life. You're gonna, and I'll tell you, folks, it's no fun to lose money. It's no fun. People have often told me this. They all say the same thing, and I've felt it too. It feels like somebody punched you in the stomach, punched you in the gut. Just how could I be so stupid? No, it has nothing to do. It's nothing to do with you, unless you really did pick something really stupid like Bitcoin or one of those other things. No, it's going to happen. Okay, all right. So when we come back, our last presentation for Chapter 1 will be a discussion of short-term investments. Get them out of the way when we need to park our money for 6 months, a year. Yeah, it's got to be in the bank. It's got to be in a CD. It's got to be in a money market or one of the other, if we have tremendous sums of money, more well-heeled short-term investments such as commercial paper or banker's acceptance notes. See you in our last presentation for Chapter 1. Dear students, we are so proud of you, so incredibly grateful and honored that you are in our class. Remember, we want this to be the best class you have ever taken. Yeah.